It is 3:01. We said we'd get started at 3, so I'm going to kick things off. My name is Alan Hensley. I'm a wealth advisor here at Financial Insights Wealth Management here in Tacoma. Thank you all for joining us here today. I've been with the firm now just about a year and a half, and it's exciting for me because this is my favorite part of the job. I think financial education is a soapbox that I could get up and talk about all day long. So I will try to keep today's presentation relatively high level. So I just want to throw that out there first. We're going to do kind of a crash course in some of these topics. We're not going to get too deep into the weeds. But if you do have follow-up questions, or if you have questions throughout this presentation, I would love for this to be as conversational as possible. I know Zoom, you've got the chat, you've got questions you can submit, you can raise your hand. I'll try to get to that between sections. But as we think about what this presentation is all about and who this is designed for, I did specifically create this content for those that are mid-career. In other words, if you're still working, you're still contributing to a retirement plan, this is going to be really educational and really helpful for anyone that still has like a 401k available to them at work. So number one, we'll start there. And this is also for those that are close to retirement, or maybe you've been retired for a long time and you're just thinking of new ways to optimize how you use your 401k or your IRA, or you're thinking of ways to be charitably inclined. So there's a little bit for everyone in today's presentation. And this is, if you're retired and if you've been retired for many, many years, maybe take some of this info that we talked about at the beginning if you have friends and family members that are still working, or maybe you have kids, or maybe you have grandkids that just got their first job and they've got a 401k available to them at work, but they don't know what to do with it. I think this will give you some great, at least teasers for what to talk about. So this is an ambitious presentation. Like I said, I am going to try and leave some room at the end for questions, but 35 minutes is kind of my target. So again, I want this to be really, really condensed in terms of the information, but hopefully you have some good takeaways. And here's the agenda. I want to talk about updated 2025 rules around retirement accounts, specifically around the contribution limits. How much can you save in a retirement account? And then I do want to at least talk a little bit about pre-tax versus Roth versus after tax. This might be something you've never heard of, but there is this kind of third flavor of a 401k called the after tax. So I'm going to dig into that because it does lead me to the mega backdoor Roth 401k, which I'm really excited to tell everyone about today. And before you ask, no, I did not come up with that name. The industry calls it the mega backdoor Roth 401k. Not a lot of creativity in the world of finance, I suppose, but you'll see why it's called that here in a second. So those first three sections, that's really designed for those that are still working, still contributing to a work plan. And then the second half of the presentation, I want to talk about Roth conversions. If we're thinking about different ways to get money into the tax-free retirement accounts, the Roth accounts, we're gonna talk about how to convert, what to think about from a tax perspective on the pros and cons of Roth conversions. And then I want to finish just a little bit around the idea of how to use your retirement accounts, specifically your IRAs, for charitable giving. If you're charitably inclined and you're looking for ways to be more tax efficient with how you give, maybe the IRA is a good place to do it from. And then, like I said, we're going to save room for questions at the end, but don't feel like you have to save it. If I fly by a slide way too fast, if I talk about a topic really quickly, but you want me to dig into it a little bit more, like I said, throw up the hand. I'll try to answer questions in between these different sections. But with that said, I'm just going to dive right in. I'm really excited. So number one, let's talk about contribution limits. So if you're looking for ways to save for retirement, great, but just know that you can't save an unlimited amount per year into a retirement account. And here are all the different limits that are going to be applicable for our conversation today. Number one, IRAs, traditional Roth IRAs. Interestingly enough, they didn't increase the amount from 2024 to 2025. So these are the same rules for IRAs that we had last year. You can put up to $7,000 into an IRA. And if you're 50 or older, or if you're turning 50 this calendar year, you can do a $1,000 catch up. So the most you can get into an IRA or a Roth IRA would be $8,000 if you're over the age of 50. If you're self-employed and you're contributing to a SEP IRA, there's this compensation rule. You can only do up to 25% of how much you make. And then the max is $70,000. So that's a little bit higher than last year. And then you'll notice in the bottom left here, I did list health savings accounts. So HSAs, not technically a retirement account, but I threw it on here because if you do have an HSA, so if you're working, you have a high deductible health insurance plan that's part of your medical insurance. If you're putting money into an HSA, I would encourage anyone that has that account to think of it like a retirement account. This is the only account that I can talk about that has the tax advantages for contributions and for distributions. So real quick, you can put money into an HSA and that actually lowers your taxable income in the current year, similar to how a traditional IRA works. And then if that money grows over time, again, let's say it's in an account for 10, 20 years, in retirement, you start using that for qualified medical expenses, those distributions are tax-free, kind of similar to how a Roth IRA works. So this is, in my opinion, a very underutilized account that should be something that we designed for retirement. So I'm not going to spend a lot of time on that today. That could be its own presentation in itself. But the health savings account, those contribution limits did go up a little bit today for individual or family. And this is the one where most catch-up rules start at age 50. The HSA has got that unique 55 and up rule. And then the 401k, this is what I really wanted to talk about today. The 401k contribution limit went up a little bit. So it was 23,000 last year. Now it's 23,500. The catch up for those 50 and over is $7,500. So, for example, if you're 55 years old, you could put $31,000 into your 401k. Fantastic. But there's this new super catch up rule. And again, we're not very creative on the names here, but this is brand new for 2025. And this is, again, very kind of a unique age range. Now, how they came up with this age range, I have no idea, but just know that if you're between the ages of 60 and 63, instead of the $7,500 catch-up, you could actually do this super catch-up of $11,250. So again, hypothetically, let's say that you're 61 years old, you're still contributing to your 401k at work. Well, that means you could do $34,750 is the ceiling for your contributions into the 401k. I know it's kind of a lot to think about. And because these rules are so new, maybe your 401k administrator hasn't caught up to it yet, but just know that this is a really, really great way to save as much as possible in retire or for retirement. But let's not forget, IRAs have these really special rules. So I know I just talked about the 401ks, but just to rewind, take one step back. Let's make sure that we're on the same page about IRA income limits. This is one where if you don't want to think about it too much, just know that if you're looking to put more money into your traditional IRA or into your Roth IRA, there's this ceiling on your income. So remember, we just talked about these are the contribution limits, but just note you're not allowed to contribute if your income is too high. So you can see there, depending on how you file your taxes, if you're a single tax filer or if you're filing as a married couple, if your income is above those limits you see on the screen there, unfortunately, you can't make a direct contribution to your IRAs. The Roth, it just has that phase out. And for traditional, if you want your contribution to be deductible, you got to be within those or below those ranges. Little asterisks on this one you see at the bottom of the screen that you may be eligible to contribute to a backdoor Roth IRA without income limits. If that is something that you think might fit for your situation, we should definitely connect offline. But just know that these income limits, they do change every year. They go up a little bit every year. And right now for 2025, these are the limits. This is one where I do get these questions, hey, but where can I save more? And that's where I'm always going to point back to the 401k. So if you're working and you're above these limits and you can't contribute to your IRA or your Roth IRA, just know that there's a lot of ways to get money into your 401k, and that's about next. So with all of those contribution limits, I've been mostly focused on what are the limits as an employee. Again, 23,500 plus the catch-ups, that is the employee portion of how much can go into a 401k. But let's not forget, there's other ways, employer contributions. Think of that as if you're working and you have a match, that is also money that can go in there. And that's not subject to those same contribution limits, the 23,500 or the 7,500. So the total ceiling is actually a lot higher than people realize. $70,000 is the total contribution limit for a 401k. And again, that's for those 50 and under. If you're over the age of 50, you get those catch-ups on top of that. So whenever someone tells me like, oh gosh, I'm just trying to figure out ways to save more, just know that the 401k has a much higher ceiling than you think, especially if you've got the ability to make after-tax contributions, which I'm going to talk about here in a second. So that was kind of a lightning round. I know we're hitting the ground running, but I just want to make sure, again, we're all on the same page about these are the contribution limits, how much you can save per year into these different types of accounts. There's also these income rules that you need to be aware of if you're trying to put money into an IRA. And then the ceiling for 401k might be a lot higher than you think. Now, let me talk about some of the specifics. Now that we've got kind of that as a base case, let me just make sure we're on the same page about the different ways to get money into a 401k. A lot of today's conversation is going to be around contributions. So number 1, 2, and 3, you see on the right-hand side there, the pre-tax is a great way to save money in a 401k and also reduce your taxable income for the current year. The Roth, this is a fantastic way to save money in a tax-free account for retirement. Doesn't give you a lot of benefits from a tax perspective in the current year, but this is totally available to you. Now, number 3, after tax, I keep talking about that. I keep hinting at it. I do want to be clear. This is not available in every 401k. So, if you're currently working and you're looking to save more and you'd love to put money in after tax, you've got to check with your HR or with your 401k administrator to see if this is even possible. But just know that this is becoming more and more popular. 10 years ago, 1 out of 100 401k plans that I reviewed would have this after-tax option. But now in 2025, I am seeing this available more and more often, especially at the really big companies, the tech companies, for example, the Amazons and the Metas and the Microsofts of the world. I know that they have this as an option, and this is where it becomes a really powerful savings tool for those that work at those companies. But just know that, getting money into a 401k, let's not forget the employer matching. Again, your employer might match 4% if you put in 8%, or they might put in 2% if you do 4%. It's different at every company. A lot of times this is referred to as, the free money. Don't leave money on the table if your company does a matching program. So employer match is another way to get it in there. And then I did throw it on there, a rollover. Technically, that is another way to get money into a 401k. But I just want to make it clear, if you have an old 401k from a previous job, or maybe you've got an IRA that you just want to put into your 401k, you can do that as a rollover. And that doesn't affect those contribution limits. That does not impact that $70,000 that I just reviewed. So these are the different ways, and I keep talking about it. So let me really break down how all of these different contributions work, because this is where we've got to do a little bit of short-term planning mixed with long-term planning when it comes to, are you making a pre-tax or a Roth or an after-tax contribution? So just to be clear, when you make a pre-tax contribution to your 401k, this is the traditional, you're going to save on taxes in the current year, and then you're going to pay taxes later. These are very commonly referred to as tax-deferred retirement accounts. You're just kind of kicking the tax can down the road. It's going to save you money in the current year, but just know in retirement, after you're in your 60s or 70s or whenever you actually need to use this money, dollar for dollar, every time that you take a distribution from a tax deferred account, that's when you pay taxes. So putting money in pre-tax saves money now on taxes, and you pay taxes later. The Roth works the opposite. Roth means that you're paying taxes already on that contribution so that you save taxes later. This is most commonly referred to as the tax-free account. So in other words, if you're putting money into your Roth 401k, that is not going to reduce your taxable income in the current year. But once it's in there, and then once hopefully it starts growing, all of that growth over time, as long as you follow a couple of rules and you wait until you're at least 59 and a half, all of that's going to be tax-free later in retirement, which, if I had a crystal ball and could tell you where tax rates are going to be in 5, 10, 20 years, then we could really accurately plan where to put your contributions to get the biggest impact. But unfortunately, we don't know what taxes are going to be in 20 years. In a lot of regards, we don't know what taxes are going to be in a couple of years. So a Roth is a really great way to make sure that you're just giving yourself a tax-free option once you're retired. And then let's talk a little bit about that third version of the 401k, the after tax. So these are contributions, they're already taxed, similar to the Roth, but technically not a Roth. And really, the only reason that you'd want to put money in after tax into your 401k is so that you can do the mega backdoor Roth. So I've got a slide on this here in a second, so don't worry, we're going to talk about it. But again, the only reason you'd consider doing an after tax is if, number one, you're already maxing out your contributions. So if you're under the age of 50, you're already hitting that 23,500, or if you're past the age of 50, you can do those catch-ups. And then we're just looking for more ways to save. That's where the after tax comes into play. The last thing I'll say about these contribution rules or ideas, down there at the bottom, it's a combo. There's no rule saying that you have to pick one or the other. If you want to do half of your contributions into pre-tax and then half into Roth, that's totally fine. You can do a little of both. You can do 60-40, 80-20, whatever that number is, as long as you stay under that contribution ceiling, the 23,500 or anything like that. So just know, if you're trying to figure out, should I do the pre-tax? Should I do the Roth? Maybe the answer is both. And this is where I work with a lot of clients figuring out what that ratio should be so that, again, we're saving a little bit on taxes now, but we're also setting ourselves up for tax-free growth in the future. But let's talk about the mega backdoor Roth. I think I've been hinting at it long enough in this presentation. What you see on the screen here is just an example. This is not a playbook by any means, but I just want to create this hypothetical example of, let's say you're 55 years old, you're saving in a 401k, and you do have the after tax available to you. So how does it work? Why would you do it? Well, again, let's just kind of go through these different buckets one by one. Number one, you're putting in pre-tax. Maybe you're trying to lower your taxable income by as much as possible in the current year. So you're maximizing that, the 23,500, check. Again, in this scenario, let's say that you're 55 years old, so you can do the catch-up. So it's another 7,500. Great. And then the after tax, I just picked a number. I'm not saying 20,000 is the number that's going to work for everyone. I'm not saying that's the maximum amount or the minimum amount. Just kind of pick that one out of thin air. But let's say you do another 20,000. So just looking at the numbers there, going down the road, you can put up to $51,000 in this scenario into a 401k. That's a lot more than people realize. And this is, again, remember we're looking at 70,000 is the ceiling. So this isn't even the maximum amount. But on the right-hand side, you can see there's converted to Roth 401k. So this is the whole reason the mega backdoor Roth is so appealing to anyone that's working and this is an option to them. Most 401ks that offer the after-tax contribution as an option also have the automatic option to convert whatever amount you put in after tax to the Roth 401k. So this is, and I know I'm getting a little deep into the weeds all of a sudden, but this is a great way for you to put money in pre-tax, lower your taxable income as much as you can, and then also get as much as you can into the Roth 401k through this back door. And when I say automatic, for the plans that I've reviewed at some of the big custodians, you can just let them know, hey, I'm putting in after-tax contributions. As soon as that goes into my account, please just automatically convert that over to the Roth 401k. And they'll do it for you. This used to be a very manual process back in the day. But as you can see on the screen here, if someone is kind of mid-career, getting close to the end of their career and looking for ways to maximize how much they save, this is the place to do it if it's an option. All right, I'm just going to pause here, see if there's any questions. I don't think we had any yet, but and I know I'm going through this really quick. I think hopefully this is a lot of food for thought. You can take this information, apply it to your current job if you're working, or again, if you have family members or kids or grandkids that are trying to figure out what to do with their 401k, make sure that they know about all these different options. All right, let's talk about more ways to get money into your tax-free, into your Roth accounts. So when I say Roth, I'm really specifically just calling out the tax-free bucket for retirement accounts. It could be a Roth 401k, it could be a Roth IRA. There's lots of different Roths nowadays because of the Secure Act. But a Roth conversion is very different than a Roth contribution. So I want to emphasize that fact right now. What we just looked at, what we just reviewed together were the contribution rules for Roth IRAs or Roth 401ks. This is totally different. This is a conversion. Doesn't those rules that we just talked about, $7,000 or $8,000 a year or 23,500, throw those out the window here for a second. We're just going to focus on how do you get money out of your traditional IRA into your Roth IRA? Or maybe you have a big bucket of pre-tax of traditional IRA money and you don't even have a Roth. Maybe this is the point where you want to put money into a Roth so that you have tax-free money later in retirement. That's done through a Roth conversion. Now, a couple of disclaimers. If you're thinking about doing a Roth conversion, number one, make sure you know that this is moving money from a traditional IRA to a Roth so that any amount that you convert is taxable. You can do this conversion whenever you want. It's not like you have to wait to a certain age, and there isn't a certain ceiling on how much you can do. You can do any amount that you want, but just know the amount you convert is taxable. So again, the limit, there is no limit. But the taxes is typically why people don't do a huge conversion all in one year. So let me explain a little bit more. And I should have called this out earlier, but hopefully everyone on the call here realizes I am not an artist. This is the limit of my illustrative skills here, these two big green buckets. But this is really a simplified version of what a Roth conversion is. You've got money in your traditional IRA and you want to move it over to your Roth IRA. Great. You can do that. Like we just said, there's no limit on how much you can do. You can do it whenever you want. But here's the catch. The amount you convert is totally taxable. So if you convert $10,000 from your traditional IRA over to your Roth IRA, that just means your taxable income went up by $10,000 in that current year. So you're going to have to make sure you've got money set aside to pay those extra taxes. This is where I think sometimes confusion can leak in because conversion and contribution, remember, those are totally different things. I also want to point out, and it's at the bottom of the screen here, if you're thinking about doing a Roth conversion, just know that it's a taxable event in the calendar year in which you do it. So just to really clear that up, if you were looking to make a Roth contribution, you can make that for the previous year. So right now it's February 2025. If you wanted to make a contribution into your Roth IRA for 2024, you can still do that. You've got until the tax deadline to make contributions. Conversions, totally different. If you're doing a conversion in 2025, it's going to count for 2025. There's no way to do a conversion for the previous year. I just want to bring that up because sometimes these rules get a little jumbled. But this is one where a lot of people that I work with, it takes really careful planning on knowing when and how much to convert when it comes to getting money out of your traditional IRA over into your Roth IRA. And there's a lot of different moving parts to figure out when to do it. But here's my of at least a starting point when it comes to doing a conversion. And I call it the income valley. Again, this is the limit of my artistic skills, but you can see here, I've got kind of two different sides to the valley here. When you're working and then when you're retired, you usually in your working years, you've got a salary, maybe you've bought and sold a home, maybe you've got stock options. So, typically your income is relatively high. And then when you're retired, you've got Social Security income, you've got maybe pensions, you're taking distributions from your IRA. I didn't put it there, but maybe also you sell a home in retirement, those kind of things. So that's usually when you're at peak income is working, and then a little bit lower is retired. But let's say that you retire at 62 and you don't start collecting Social Security immediately. Let's say you don't start your pensions or IRA distributions for a few years. There's this valley in your income where you're in a relatively low tax bracket for maybe a year or a couple of years, or maybe 10 years, depending on how early you retire. And I'm using this example of working versus retired as an illustration of the income valley, but it could also be maybe you're going to take a sabbatical from work. Maybe you're going to take a year off and all of a sudden you're in a really high income tax bracket. And then during that sabbatical, you're in a really low income tax bracket. That's another income valley. Just think of this is the years in which you're not in your highest tax bracket. That's the perfect time to consider doing a Roth conversion. Because remember, every dollar that you convert out of your traditional IRA, convert it over to a Roth IRA, that's dollar for dollar, that's taxable income. Well, if you're in, the 24% or the 32% tax bracket while you're working, and then all of a sudden you drop down to the 12% bracket during that income valley, that's a perfect opportunity to take some money out of your traditional IRA and convert it over to Roth and only pay maybe 12%. So, that's what I mean by being very strategic. Having tax-free income later in life through a Roth is great, but you want to do it very strategically depending on what your income is, what tax bracket you're in. So again, there's no limit on how much you can convert, but just know, if you do a huge Roth conversion, that might bump you up a couple of tax brackets. So there's this kind of sweet spot of after retirement, before Social Security, when income dips, this is where a retiree should be or could be in a lower tax bracket that makes Roth conversions really, really attractive. And this is one where it's a year by year thing. Let's come up with a plan for this year and then kind of reevaluate each year after that. But let's keep that in mind. If retirement's around the corner, or if you just recently retired, this might be something that we want to try to attack. Just know that there's more taxes you're going to have to pay now, setting yourself up for more tax-free income in retirement. All right, I feel like we're flying through a lot of these topics, but it's all good stuff. Most of what we just talked about were for those, still working or getting ready to retire. When it comes to charitable giving, this applies to everyone. Definitely, if you're in your retirement years and you're charitably inclined, let's say you give money to a nonprofit or you give money to a church, this is really impactful. And this might be something you've never considered. So, if you're giving, you're just kind of writing a check once a month or once a year, it's easy. There's not a lot of tax advantages to it per se, but I want to dig into that right now. I want to talk about 3 topics when it comes to retirement accounts and charitable giving. I want to talk about qualified charitable distributions. Those are most commonly referred to as QCDs. I want to talk about adding beneficiaries to a retirement account. That's another way to give maybe with your estate. And then I just want to introduce the concept of a donor advised fund, or what I'll probably call a DAF, as we go through the rest of this presentation. And then just quick note at the bottom there, I just want to call out, this is a really simple check that you can do at any time. Do the beneficiaries listed in your will match the beneficiaries on your IRA or your 401k, or maybe you have life insurance? If there's a mismatch, then I would encourage you to do a little bit of estate planning. And with that in mind, just know that our next Wisdom and Wealth is coming up on May 21st. It is going to be focused on estate planning. And here in the state of Washington, we have the Washington State estate tax. So if your net worth is over 2.193 million, there's a little extra work that you should do with your estate plan just to make sure that your heirs aren't paying estate taxes when they don't have to. So a little bit of a teaser, keep that on the calendar. May 21st is going to be our next Wisdom and Wealth, that we'll talk about estate planning. And since I'm talking about upcoming financial insights events, we are going to do just a fun March Madness watch party at the SPAR here in Tacoma on March 27th. So if you're interested in that, we're going to send out invites soon. Again, March 27th in the afternoon, we'll do a little basketball watch party. It'll be fun. Hopefully you all can make it. We'll send out the invites soon. All right, back to retirement accounts. Let's talk about qualified charitable distributions, QCDs first. So to QCD or not to QCD, well, first we need to understand when and how you can do one if you want to. Number one, you have to be at least 70 and a half years old. And I know a lot of you might be thinking, well, didn't they just change the required minimum distribution ages from 70 and a half to 72 or 73 or 75? Yes, you're absolutely right. A few years ago, they increased the RMD age, but for some reason they left the QCD age at 70 and a half. And why they picked a half a year for that rule, I have no idea. But that is still the qualifier, 70 and a half. This has to come from like a traditional IRA. So at the tax deferred account, that's the one where you put money in, you got a tax break, so to speak, with the contribution, you're deferring the taxes to later. So your traditional IRA is where you'd make a QCD from. And there is a limit for 2025. That ceiling is $108,000. So if you want to give up to $108,000, you can do it from an IRA as long as you're over 70 and a half. It can be a tax-free distribution. And that leads me to, well, why? Why would you want to make a QCD? Well, if you are charitably inclined, and let's say that you're giving, a couple $1,000s a year, well, for a lot of people, if you're giving less than the standard deduction, you're not going to get a tax write-off on those charitable or those charitable contributions. So when you think about giving and you're trying to think about where to give from, a QCD means that if you give to a charity out of your IRA, that distribution is tax-free. So just kind of let that sink in. And remember, just quick recap, anytime you take money out of an IRA, that's taxable. We talked about that with the Roth conversions, but just know that let's say you want to take a withdrawal from your IRA, you're going to have to pay taxes on that withdrawal unless it's a QCD. So this is a great way to give to the charities that you love and you've been giving to for years and to have money come out of your IRA tax-free. The other benefit to that, besides having that tax-free distribution, is this could potentially reduce your future required minimum distributions. So reducing future RMDs is another tax strategy for those, let's say you're retired at age 65, your RMDs are going to kick in at age 75. So you're just trying to think of ways, well, I'm not going to need all the money from those RMDs. How can I reduce the amount in my IRA so that I don't have these big taxable distributions that are required in 10 years? QCDs, a great way to do it. The last thing I'll say on QCDs, because this comes up a lot and right here in the middle of tax season, QCDs are not tax deductible. I want to make it very clear. If you're currently giving to a charity right now, you might have those contributions to the charity or the church. That might be a tax deductible event. Well, this works totally differently. When we do a qualified charitable distribution out of an IRA, the benefit is it comes out of the IRA tax-free, but you don't get to write off that charitable contribution as a deduction on your taxes. So distributions are tax-free, but you cannot claim the deduction. So there's no kind of double dipping, so to speak. But this is, again, I think a relatively unknown. It's becoming more and more popular these days. So if you are over 70 and a half, and if you're giving to a charity, please consider a QCD as a way to make it a really tax efficient way to give. All right, real quick, I'm not going to spend a ton of time on this topic, but let's talk about just listing beneficiaries on your retirement accounts. So this is more for estate planning. Again, if you're thinking about different ways that you can give after you pass away, this is just, I think, a strategy that a lot of people haven't considered. Number one, you'll see there I put separate IRAs. What do I mean by that? Well, let's say that you want to gift or you want to leave $10,000 of your IRA to a certain charity. Well, if you just have one IRA, you've got this big IRA and you've got lots of different beneficiaries listed. Maybe you have kids or your spouse or other family members, and then you've also got the charity listed there. It can get kind of confusing just knowing, well, how much is it going to go there? Because you have to list a percentage. One idea, this is a hypothetical scenario, you could open a separate IRA. Let's say you just open a second IRA, you put $10,000 in it, and you just list that one beneficiary as the 100% beneficiary on that smaller IRA. And it's kind of what I call mental accounting. There's not like a lot of tax advantages to doing this ahead of time or anything like that. But it's just, you can say, all right, this big IRA, that's mine. I'm living off that. That's going to go to my kids. And then this relatively smaller IRA is going to go to this charity. And you can always change it. The flexibility of beneficiaries on retirement accounts, super easy to update or change or adjust along the way. But that is, I think, something that is a simple thing to do. And it also just makes kind of giving from your estate a lot easier for your executor, the personal representative that you list in your will. Just makes life a little bit easier for them. So consider just having separate IRAs for different charities, and you can list that charity as the 100% beneficiary. The other idea that I want to talk about today, and I'm really just going to kind of touch on the tip of the iceberg, so to speak, on a donor advised fund, the DAF. This is, again, it's been around a while and it's gaining in popularity. But this is another way to give, and I'll talk about this. I have a whole other slide here in a second, where you can give during your lifetime to a DAF, or you can list a DAF as a beneficiary on your IRA, which could have really, really impactful benefits for reducing your taxable estate after you're gone. Put a pin in that. I'm gonna talk about that here in just a second. But the last thing I'll say about beneficiaries, typically it's not advisable to list a charity or a nonprofit as a beneficiary on a Roth IRA. So this is one where the Roth IRA, you've got that tax-free growth, and if you leave it to your heirs, again, your kids or your family members, if they inherit a Roth IRA, those distributions are still going to be tax-free from the Roth. Leaving a Roth IRA to a charity doesn't make a lot of sense from a tax perspective because the charity they're not paying taxes, so that tax-free growth doesn't really get passed on. So if that's your only asset and you really want to leave it to a charity, of course that's still an option, but just from a tax perspective, it usually is not something that we advise. All right, so let's talk a little bit about a donor advised fund, and this is I kind of debated on putting this in here. This could be its own presentation in the future where we really dig into the ways to give to charity. But let me just explain the donor advised fund. It is a perfect way to just make your giving more flexible. So, if you're not exactly sure which organizations you want to support, a DAF gives you or your heirs kind of time to figure that out. And if I explain what it is from kind of a 30,000 foot view, a donor advised fund, it's not a charity in itself, but the money that goes into the donor advised fund, that does count as a charitable contribution. So if you're making contributions during your lifetime to a donor advised fund, that is, I think, a really helpful way to what I call front load your charitable donations. So, for example, if you're giving $10,000 a year to different charities, maybe you're not getting the tax write-off because you're still under the standard deduction. Well, one idea is you could put $100,000 into a donor advised fund and then still give it to the charities over 10 years. So again, $10,000 a year over 10 years, kind of like what you're already doing. But in that example, you get to count that $100,000 contribution all in one calendar year. So that's what I mean by front load. You're still going to make your charitable donations just like you always have, but you get to kind of wrap all of those donations into one year from a charitable deduction standpoint. But what I really wanted to talk about today is how does this help your estate? Well, if you list a donor advised fund as a beneficiary on your IRA, and again, we could set up a separate IRA, it could be a portion of your IRA, the amount that goes to the donor advised fund will reduce the amount of your taxable estate. And again, this is kind of a teaser for future meetings that we talk about estate planning. But here in Washington, if your net worth is over $2.193 million, there are a lot of reasons why you should try to reduce that taxable estate. And a DAF is one way to do that, with a beneficiary listed on your IRA. So I know I'm kind of just jumping around here a little bit, but finally, the legacy of, you get to list a DAF and then whomever you list that's going to take over that donor advised fund, that's a great way just to make sure your charitable donations kind of continue your legacy even after you're gone. It creates, I think, in my opinion, it's really a nice way to continue giving through your estate. All right, I'm looking at the clock. Tried to keep this at 40 minutes. And here we are, questions. And I'm happy to review anything. I know I just kind of speed ran through all of that, but does anyone have any questions, concerns? Can I review anything? Just see if we got anything here. See anything? This was really fun. Hopefully you took something from this. Like I said, we are going to make this presentation available for you to view on our YouTube channel. So we'll send that out to you. So if you missed something, or if you want to share this with anyone that might get something out of it, like I said, if someone's still working and they're not taking full advantage of their 401k, this is a great way to do it. Or if someone is curious on how to be more efficient with their taxable giving, that's a great way to share this. So we'll get that out there. We're going to do at least 3 more of these throughout the year. We'll send out invites for the next one in May about estate planning. And I'll just close and say, thank you. Thank you for coming today. Hopefully you learned something. If you have questions, you want to connect with me offline, don't hesitate to reach out. Happy to review anything one-on-one, and we'll see you at the next one. So thanks so much. Have a good day, everybody.